Welcome back, everyone. If you've been watching the precious metals market over the past few days, you already know something significant just happened. And if you haven't been watching, well, that's exactly why we're here today, because this is one of those moments where things move fast, and a lot of people are left wondering what on earth is going on. Silver just dropped to $73 an ounce. Gold fell by $118 in what analysts are calling one of the sharpest single-session sell-offs we've seen in recent memory. And I want to be honest with you right from the start. This is not a panic video. We're not here to frighten anyone. What we are going to do today is sit down together, look at the facts, walk through what actually happened, understand the forces behind this move, and then talk about what it might mean going forward. Because whether you hold gold and silver, whether you're thinking about it, or whether you're just someone who wants to understand how markets work, this story matters right now. So let's get into it. Let's break this down from the very beginning, and by the end of this video, you're going to have a much clearer picture of why precious metals move this way, what history tells us about moments like this, and how to think about all of it without getting swept up in the noise. Gold and silver have always held a special place in the world of money and investing. They're not like stocks. They're not tied to the earnings of a single company or the fortunes of a specific business. For thousands of years, these metals have been a store of value, meaning people hold them when they want to protect wealth, when they're worried about inflation eating away at their savings, when they're nervous about currency losing its purchasing power, or when they just want something real and tangible outside of the traditional financial system. That's the foundation. Keep that in the back of your mind as we move forward, because understanding why people buy gold and silver is just as important as understanding why they sometimes sell it quickly. Now, here's what this means when we see a sudden, sharp drop like the one we just witnessed. When gold falls $118 in a short window and silver slides down to $73, it doesn't automatically mean the metals have lost their purpose or their long-term value. It means something shifted in the broader financial environment. Something changed in a way that caused a significant number of investors to move money out of gold and silver and redirect it somewhere else. Our job right now is to figure out what that something actually was. Think about it this way. Imagine you've been carrying an umbrella for weeks because the forecast kept calling for rain. But then one morning you wake up and the sky is completely clear, the sun is shining, and the weather report says it's going to be dry for the next 2 weeks. What do? You probably leave the umbrella at home. You don't need it right now. Precious metals work in a similar way for many investors. When people feel the financial weather is improving, when the economy looks more stable, when interest rates are moving in a direction that makes other assets attractive, when big risks seem to be fading, they put away the umbrella. Some of them sell portions of their gold and silver and move that money into things that generate income or returns. That shift in sentiment is a big part of what drives these sharp moves. So what was the financial weather like leading into this sell-off? The honest answer is it had been stormy for a long time. Through 2024 and into early 2026, precious metals had a strong run. Gold had climbed meaningfully from where it was just a couple of years before. Silver had its own impressive move. A lot of that was driven by real uncertainty, persistent concerns about inflation, serious questions about government spending and national debt levels, geopolitical tensions around the world, and a general feeling among many investors that the traditional financial system was under pressure. All of that was fuel for gold and silver. And now something has shifted in how the market is reading those signals. Here's what this means in practical terms. When you have a significant run-up in any asset, whether it's stocks, real estate, or commodities like metals, you tend to accumulate a large number of investors who are sitting on profits. Some of them bought early and have big gains. Some bought more recently and have smaller gains, and some bought near recent highs and are close to breaking even. When the market hits a moment where there's a real catalyst, some economic data, some policy signal, some shift in sentiment, it can trigger what traders call a flush. The people sitting on profits decide to take some off the table. Positions bought with borrowed money get forced out when prices fall below certain thresholds. And suddenly the selling creates more selling, because falling prices trigger automatic stop-loss orders and a general wave of nervousness. That dynamic is not unique to gold and silver. It happens in every market at various times, but it can look dramatic and alarming when it unfolds quickly. Now this is important because I want to make sure we're distinguishing between two very different things. There's a price correction, and there's a fundamental change in the value or purpose of an asset. A price correction is when something that has risen a lot, pulls back. The market is essentially digesting gains and finding a more balanced level. A fundamental shift is when something changes in the underlying reason why that asset matters. Those are very different situations, and they call for very different responses. What we appear to be looking at right now has more of the characteristics of a correction than a fundamental breakdown, but let's keep unpacking the details so you can form your own view. Let's talk about some of the specific forces driving this particular sell-off, because context matters enormously here. One of the most significant factors is the relationship between gold and interest rates. Gold doesn't pay interest, it doesn't pay a dividend, it doesn't generate cash flow the way a bond or a savings account does. When interest rates are very low, that's not a big problem. You're not giving up much by holding gold instead of other things. But when rates are higher, or when there are signals that rates might stay elevated, gold suddenly has real competition for investor attention. You can put money into treasury bonds and earn a meaningful yield. The cost of holding gold instead goes up in the minds of investors, and some of them reduce their exposure as a result. Reports around current economic conditions and central bank signals appear to have shifted expectations in a way that put that kind of pressure on metals pricing. On top of that, there have been softer readings on certain inflation data. Remember, one of the primary reasons people hold gold is as protection against inflation. When inflation is running hot, gold tends to be in strong demand because people want their wealth to hold its value. But when inflation data shows signs of cooling, that urgency fades. Some investors look at the numbers and think the situation is less alarming than they had feared, and some of them trim their precious metals positions in response. Whether inflation truly is under control or just temporarily quieter is a question nobody can answer with certainty right now, but the market is reacting to the current data it has. And then there's the US dollar. The relationship between the dollar and gold is one of the most important dynamics in the precious metals world. Generally speaking, when the dollar strengthens, gold tends to face headwinds. That's because gold is priced in dollars globally, so a stronger dollar makes gold more expensive for buyers in other countries, which can dampen international demand. Movement in the dollar during this period has added another layer of pressure on metals prices. Now let me give you some historical context because I think it helps put this moment into perspective. This is far from the first time we've seen a dramatic drop in precious metals. Back in 2011, gold hit what was then an all-time high near $1,900 per ounce, and then over the following years it fell sharply, at one point trading down near $1,050. That was a significant multi-year decline. There were plenty of voices saying the gold story was over, that the thesis had broken down permanently, but then gold started climbing again. By 2020, it had surpassed its 2011 highs, and it kept going from there. Silver has an even more dramatic history of violent swings in both directions. The point is not that history guarantees any particular outcome. The point is that sharp moves in precious metals are part of the nature of these markets. They don't, by themselves, tell you what comes next. If you've been finding this breakdown useful, if this kind of calm, clear analysis is what you've been looking for, please take a second to hit that like button and subscribe to the channel. It genuinely helps more people find content like this, and I put real work into making sure these videos give you something actually useful. Let's talk about what this current drop means for different types of people who are paying attention to this market. Because not everyone watching is in the same position, and the implications are genuinely different depending on where you're coming from. If you already hold physical gold or silver coins, bars, whatever form, this drop is uncomfortable to look at. There's no pretending otherwise. Watching the value of something you own fall in a short time does not feel good. But the key question to ask yourself honestly is, why did you buy it in the first place? If your reason for holding precious metals was a long-term one, wealth preservation over time, diversification, a hedge against financial uncertainty, then a short-term price correction doesn't change that underlying logic. The reasons you bought are still there. The question is whether those reasons are still valid for you today, and only you can answer that. If you're someone who bought more recently, maybe drawn in by the strong momentum of the past couple of years, this is a harder situation. Depending on when you bought and at what price, you might be looking at a loss right now. That's genuinely difficult. And this is where something important stands out: the value of understanding what you own and why before you buy it, not after. When you buy something with a clear understanding of why it fits your approach, a short-term drop is painful but manageable. When you buy something because it's going up and you don't want to miss out, a drop can feel like the ground is falling away beneath you. If you're someone who's been watching from the sidelines, curious but never quite moved on precious metals, this is actually a fascinating moment to study. These kinds of corrections show you what the market looks like under real pressure. They reveal how investors respond emotionally to volatility, and they raise a worthwhile question. At what price, under what conditions, would this asset make sense for you? That's worth thinking through, regardless of what you ultimately decide. Now let's talk about something that doesn't get explained enough: the difference between the paper market and the physical market for precious metals. When you see the price of gold or silver quoted on financial news, that price is primarily being set in the futures market. That's a financial arena where contracts are traded for the future delivery of metals, and the vast majority of those trades never result in actual physical metal changing hands. It's financial instruments being bought and sold by traders and institutions. The price set there flows through to the physical market, but they're not always identical in the short term. During periods of sharp price movement, you can sometimes see a gap between what the paper price is doing and what's happening with demand for actual physical coins and bars. That gap doesn't last forever, but it's useful to understand when you're trying to interpret what a big market move actually means. Let's zoom out and think about the bigger picture for a moment. We're in 2026, and the financial environment we're living in is genuinely complex in ways that matter for understanding precious metals. Government debt levels across major economies remain at historically elevated levels. Inflation, while it has moderated from its peak, is still a real factor in everyday household finances. The global economic order is going through a period of real transition, and confidence in traditional financial institutions is not quite what it was a decade ago for many people. All of those factors are why gold and silver attracted so much serious interest in the first place, and none of them have simply disappeared because of this sell-off. Here's a mental framework that experienced investors often use when looking at any asset during a volatile moment. Ask yourself 3 questions. First, what is the core thesis? Why does this asset have value? And what conditions support that value? Second, has anything changed that genuinely challenges or undermines that thesis? And third, given your current financial situation and goals, how does this asset actually fit? If the core thesis still holds and nothing fundamental has broken down, then a price correction is not automatically a reason to walk away. If, on the other hand, you look honestly and realize you bought for the wrong reasons, or that the thesis has genuinely weakened, that's worth sitting with seriously. One more data point worth mentioning: central banks around the world have been buyers of gold in recent years, not sellers. The institutions that manage national reserves and make decisions about how to protect a country's wealth have been increasing their gold holdings. That doesn't predict what the price will do next month, but it does tell you something about how some of the most sophisticated financial actors in the world view these assets in the current environment. Silver also deserves a specific mention before we wrap up. At $73, silver is still significantly higher than where it was just a few years ago, and the industrial story for silver remains real. Silver is used in solar panels, electric vehicles, advanced electronics, and medical technology. As those industries continue to grow, they need more silver. At the same time, a large portion of silver supply comes as a byproduct of mining other metals, which means supply can't always respond quickly to price changes. Those long-term supply and demand dynamics haven't changed because of a few days of price movement. Let's also briefly mention the gold-silver ratio. That's simply how many ounces of silver it takes to buy 1 ounce of gold at current prices. Historically, this ratio has shifted quite a bit over time, and analysts who follow these markets watch it closely as one indicator of relative value between the two metals. It's not a precise timing tool, but it gives useful context about where silver stands relative to gold in a longer historical frame. As we come to the close of this video, here's my honest summary of where things stand. What happened with gold and silver is dramatic, but it is not without precedent. The sell-off has the characteristics of a technical correction driven by profit-taking, response to short-term economic data, and shifting rate expectations, rather than a fundamental collapse in the case for precious metals. The broader factors that made gold and silver attractive, inflation concerns, fiscal pressures, geopolitical uncertainty, the desire for real diversification, have not been resolved. They've quieted somewhat in certain areas, but they have not disappeared. Whether metals fall further from here, stabilize, or eventually resume moving higher is genuinely unknown. Anyone who tells you otherwise with confidence is either overconfident or not being straight with you. Markets are complex. They are driven by the decisions of millions of people and institutions with different goals, different time horizons, and different information. They routinely surprise everyone, including people who study them professionally. What you can control is how you respond to this moment. Take a breath before making any decisions. Separate what you actually know from what you're feeling. Be honest with yourself about why you hold what you hold, and whether your original reasoning still makes sense. And be cautious about the loudest voices you hear right now, because moments like this tend to bring out both extreme pessimism and extreme optimism, and neither extreme is usually where the truth lives. That is really the whole point of this channel. Not to hand you answers, but to help you understand what's actually happening, so you can think clearly and make informed decisions for yourself. These are not simple topics, and the financial world moves fast. There is no shortage of voices trying to grab your attention by making everything sound more dramatic than it is. What we're trying to build here is something different: clear thinking, honest analysis, and a calm perspective that helps you understand what's going on with your money. If you made it to the end of this video, I genuinely appreciate you being here. Please hit the like button if this gave you real value. It truly helps this content reach more people who are looking for exactly this kind of clear breakdown. And if you haven't subscribed yet, do it now so you don't miss the next one. I'm John Smith. Thank you for watching, and I'll see you in the next video. Stay informed, stay calm, and take care of yourselves. And before you go, let me leave you with one final thought that I think is worth carrying with you beyond just this topic. The financial world will always have moments like this. There will always be a day when something you own drops in price quickly, when the headlines are alarming, when people around you are either panicking or calling it a buying opportunity of a lifetime. Learning how to navigate those moments with a clear head, that skill is worth more than any single trade or any single asset. It's the foundation of actually building and protecting wealth over time. That's what we're working toward here together, and that's why I hope you keep coming back. See you next time.